mesmerizing GDP number. Let's discuss that. We've got Garima Kapoor joining in right now from Elara Capital. Garima, hi. Were you anticipating the 7.4% number? It's surely come as a surprise to us.
Morning. Yes, it was the upside surprise a bit more sharper, but a large part of this can be explained because of sharp increase in net indirect taxes because the subsidy payout in the quarter four was significantly lower than the previous quarter. So because of which the net indirect taxes have grown by more than 12%, whereas the previous quarter, that is quarter three, the growth was only 5%. Because look at the internals in terms of activity-based indicators, the GVA is still at 6.8%. So at best, the GDP, had there been a normalized payout on subsidies, the GDP print would have come close to 6.9 or 7%. So another 45 basis point uptick or the surprise uptick that we have got can partly be explained by this statistical anomaly.
So Garima, now the Q4 numbers, which is what we're talking about, is there a Mahakumbh impact in that? Because all kind of numbers were floating around on the impact of Mahakumbh for the quarter gone by. Mathematically, no, you cannot prove it. But logically, is the Mahakumbh impact there?
See, if you look at the high frequency indicators, especially relating to travel, especially air passengers and other high service indicators, it does show the impact did play out. So we did estimate the impact to be anywhere between 15 to 20 basis points. But apart from Mahakumbh, the one other impact that really played out in this quarter was that government, which was not really spending for most part of first three quarters, had started to accelerate spending towards November and December. So the tightness in the economy, including working capital issues that certain MSMEs were facing until third quarter because of sluggish payments from the government, really started to turn around as we enter the fourth quarter. Along with that, a significant impact that took place in this quarter was that RBI changed its stance and basically started to move more towards liquidity provisions. So it started off with CRR cut, followed it up with massive OMOs that announced, and of course, then came the rate cut. So you can actually say that two large agents of the economy, government on one side and RBI on the other side, along with other aspects relating to the fact that there was Mahakumbh, etc., all did tend to have its impact on the quarter four print.
Okay. So as we look into the FY26 numbers, do you think a 7% number is something which is ambitious or it is achievable?
Look, current macro backdrop, notwithstanding the global uncertainty, tells you that 6.5% is achievable. For everything else being equal, if India wants to get to 7 or print above 7%, it will have to follow it up with reforms and factor reforms, which probably have been the missing print across last post-COVID scenario. In my assessment, the current momentum of the economy, driven by, of course, good monsoon, driven by a robust Kharif crop, which has, of course, improved realization of the rural economy for quarter four, driven by government spending and RBI's change in stance and impending rate cuts, should be good enough to take your growth to anywhere in the handle of 6.5 to 6.8% at best, despite global backdrop not remaining positive. But if we were to look at a growth to be sustainably above 7%, which is not led by statistical anomaly, which the fourth quarter print was, we certainly will have to do more than what we're doing. This current business as usual situation that we are in can take us as far to about 6.5, 6.8, not more than that.
What is the risk? Is risk tariff? Is the risk currency? Is the risk, comeback of inflation, which could always come and threaten you back, given that monsoon has been erratic? There are a lot of factors which could surprise us. So, is inflation comeback a risk?
Inflation comeback in the near horizon, at least for next 4 to 6 months, doesn't look like a risk. I'll explain why I say so. As we stand in the month of June, the main print that will come will surprise us even to the downside. Now, normally March, April, May, and June are the months when inflation spikes, largely led by perishables. This time, that pattern is not played out. So somewhere the underlying patterns in terms of either policy-led initiatives to basically manage food inflation, and of course the other factors relating to benign global commodity prices and oil are helping us. Will there be a spike closer to 4%, which is more like a normal inflation scenario for India? Yes. But does the aspect or does the vision or the visibility of that over the next 6 months look very sharp? Maybe not. Because the greater the global uncertainty, greater is going to be the risk for commodities. That gives us enough elbow room to be able to manage our inflation risk if we manage our food very well. Now, coming to the core inflation, the spare capacities that we've seen and the gradual uptick in consumption will mean that core will also not spike out of hand. And when I say core, I'm talking about core, excluding gold, silver, and petroleum and diesel. So the core as we talk, or the super core we talk about. So net basis, the next 6 months, inflation spikes look little as a probably distant risk in my view. The bigger risk to manage, of course, is going to be the continued volatility in the tariff scenario. Remember, we are continuously seeing a massive flux when it comes to global backdrop, policies that are coming from US, massive US soaring debt, very elevated US fiscal deficit, and the continued geopolitical concerns. We just had an escalation of issues between Russia and Ukraine. So, in my view, the risks are more external, emanating largely from US's trade policies, US's fiscal and debt risk, and of course, geopolitics. At this point in time, the risks domestically or internally for macroeconomic backdrop look very, very benign to me.
Garima, great to have you in on the show with that perspective on the GDP data. Let's just revisit what the GIFT Nifty is.
If you like this video, then like, share and subscribe to ET Now.